Welcome to PATRIOTS IAS. If you are new to our channel, please subscribe. There are subject-wise videos are available in our playlist. Try to watch all those videos. It will definitely help you in your preparations. This is PATRIOTS IAS Prelims Conqueror Part 4 video. National Asset Reconstruction Company Limited. The government recently cleared a rupees 30,600 crore guarantee program for securities to be issued by Incorporated National Asset Reconstruction Company Limited. So first we can discuss about the bad bank. Bad bank is an asset reconstruction company or asset management company that takes over bad loans of commercial banks, manages them and finally recovers the money over a period of time. National Asset Reconstruction Company or NARCL is the name of the asset reconstruction company incorporated to take over and dispose of the trust assets of commercial banks. The NARCL will engage with the Indian Debt Resolution Company Limited for management and resolution of the trust asset. The IDRCL is an operational entity or service company that could manage the assets and engage professionals and turnover experts in the process. The NARCL will first purchase bad loans from banks. NARCL will pay 50% of agreed price in cash and the remaining 85% will be in the form of government security receipts. When the assets are sold with the help of IDRCL, the commercial banks will be paid back remaining amount. If the bad bank is unable to sell the bad loan or has to sell it at a loss, then the government guarantee will be used. The government guarantee will be valid for 5 years. NARCL has incorporated under the Companies Act and it has applied to RBI for license as an asset reconstruction company. Public sector banks will have 51% ownership in it. IDRCL is a service company operational entity which will manage the asset and engage market professionals and turnover experts. Public sector banks and public financial institutions will hold maximum 49% of stake in IDRCL and the rest will be private sector lenders. Prompt Corrective Action Framework. Introduced in 2002 by RBI, Prompt Corrective Action is a framework under which banks with weak financial health are put under the monitoring by RBI. The framework was revised by RBI in 2017. As the most bank activities are funded by deposit which needed to be repaid, it is important that the bank carries sufficient amount of capital to continue its activities. PCA is issued to alert the RBI, investors and depositors if a bank may face problems in future. PCA helps RBI to monitor key performance indicators of banks and to take corrective measures to restore its financial health. It is applicable only to commercial banks and not to cooperative banks and non-banking financial companies. The Reserve Bank of India recently revised Prompt Corrective Action Framework. Revised PCA framework will already effective from January 1, 2021. Earlier PCA norms, banks were evaluated on capital, asset quality, return on asset and leverage. Revised framework, it excludes the return on assets. Next one is deposit insurance and credit guarantee. Deposit insurance means it offers protection to deposits of bank customers in case bank become insolvent. Credit guarantee, it is the guarantee that often provides for a specific remedy to the creditor if the debtor does not return his debt. A bank becomes insolvent when its total liabilities exceeds its total assets, usually as a result of poor investing or lending decisions. So an insolvent bank may not be able to repay all the money that it owes its depositors. In such a case, the government steps to compensate depositors, usually up to certain threshold amount. In India, deposit in public and private sector banks, local area banks, small finance banks, regional rural banks, cooperative banks, Indian banks of foreign banks and payment banks are all insured by DICGC, fully owned subsidiary of RBI. However, primary cooperative societies are not insured by DICGC. DICGC insures all deposits such as saving, fixed and current, recurring, etc. Deposits of foreign governments, deposits of central state governments, Indus Bank deposit of state land development banks with the state cooperative bank, any amount due to account of an deposit received outside India, any amount specifically accepted by corporation with the previous approval of RBI. This one is tokenization by RBI. See, it is tokenization process by which your card details are not revealed to the merchant. The new feature lets customers make card payments through a secure digital token. With this, your card details will be secure and will not be revealed to the merchant. With tokenization, only card networks and issuing bank will have the access to your details. The 16-digit number, the card will be replaced by unique code called token. Many countries have been tokenization of cards for payments available for customers. The RBI has now made this feature available to all card networks. However, the service can be used only for purchases through mobile phones and tablets. If customers lose these cards, they have to go through a lengthy process in case tokens tied close phones, and token will be easily reissued. Tokenization is particularly useful while shopping an e-commerce website. Next one is account aggregator system. India has 8 major banks recently joined the account aggregator network that will enable customers to easily access and share their financial data. The account aggregator system framework has created through an interregulatory decision by RBI and offers regulators including SEBI, RD and PFRDA through an initiative of Financial Stability and Development Council. An account aggregator is the RBI regulated non-banking financial company AA framework allows customers to access different financial services from various providers on a single portal. It allows customers to transfer financial information related to various accounts such as bank deposit, equity, mutual fund and pension funds to any other regulated financial institution in the AA network. It will help banks to reduce transaction costs, offer customized products and services to customers, reduce fraud, fast-track loan evaluation process, etc. This one is co-lending model. Co-lending or co-organization is set up where banks and non-banks enter into an arrangement. The arrangement is for the joint contribution of credit for priority sector lending. Two lender firms, in this case a bank and non-banking financial, come together to distribute loans. Banks can co-lend with all registered non-banking financial companies including housing finance company. Non-banking financial company and FCs facilitate origination and collection of house loans while banks leverage their balance sheet strengthened to house the majority of the loan. This means that 80% of the loan will reflect in the bank balance sheet while 20% in that of non-banking financial company or HFCs. Non-banking financial companies will be single point of interface for the customers and enter into a loan agreement with the borrowers. The agreement should contain the features of the arrangement and the roles of responsibility of non-banking financial companies and banks. You can go through this question. Next one is retail direct tilt accounts, RDG scheme. See, the retail investors now able to invest in the government securities. With this scheme, a common man will be able to invest in government security by opening an account with the RBI directly. With the RBI RD platform, where Government of India Treasury bills, Government of India dated securities, sovereign gold bond and state development loans can be traded. The RBI RD offers safe and simple process of investing in government securities. Additional Tier 1 bond are unsecured perpetual bonds with no predetermined maturity date. These bonds never mature. They are issued with a call option. The call option gives issuer RT1 bonds, usually banks, the right to buy these bonds from investors. The issuer of such bonds may call redeem bonds if it is getting money at cheaper rate, especially interest rates are falling. The holders of RT81 bonds do not have a put option, which means investors cannot return these bonds to the issuing bank and get back principal amount. Like other bonds, 81 bonds pay a fixed rate of interest at regular intervals. However, if banks face bankruptcy or capital shortage, they can dismiss principal amount and not pay interest. 81 bonds can also be listed and traded at exchanges. 81 bonds are regulated by RBI. Next one is moderating bond yield. In April 2021, RBI launched government securities acquisition program, under which it is said to be buy 1 lakh crore worth of bonds in this period. The bond yield is return and investor realize on a bond. Mathematical formula on this. This is all about moderating bond yield. Next one is e-rupee. It's cashless and contactless instrument of digital payment. It is a QR code, SMS string-based e-voucher which is delivered to the mobile of the beneficiaries. The beneficiary will be identified by their mobile number, and the voucher will be allocated by a bank to the service provider. The issuer of this will be able to redeem the voucher without a card, digital payment app, internet banking access and service provider. It has been developed by National Payment Corporation of India on its UPI platform, collaboration with the Department of Financial Service, Ministry of Health and Family Welfare and National Health Authority. E-rupee is still backed by existing Indian rupee as an underlying asset, and the specificity of the purpose makes it different from virtual currency and makes it closer to a voucher-based payment system. Last one is national digital currency. A central bank digital currency or national digital currency is simply the digital form of country's fiat currency. Instead of printing paper currency or minting coins, the central bank issues electronic tokens. This token value is backed by full faith and credit of the government. Though the concept CBDCs was directly inspired by Bitcoin, it is different from very important. It is different from decentralized virtual currencies and crypto assets, which are not issued by state or lack of legal tender status. India fairly high currency to GDP ratio holds out another benefit of CBDC. To extent large cash usage can be replaced by CBDC. Cost of printing, transporting and storing paper currency can be sustainably reduced. Also, interbank settlement could not be recurred. A CGAR committee has given recommendations for various aspects of digital currency, cryptocurrency. If you like the video, please subscribe our channel. Please share the video with your friends. There are subject-wise videos are available in our playlist. Try to watch all those videos. It will definitely help you in your preparations. Thanks for watching.